Hey everyone, this is Natalie Pace, and today's topic on our free podcast and video conference is about that Warren Buffett video that so many people are seeing online. Is it a deep fake? And if it is AI generated, then maybe it still is his strategy, something he might have said. So we're going to dig into that. Is it the truth? Is it something that Warren Buffett would approve of? Is he investing in tips or long-term bonds or dividend stocks? In fact, he did speak recently, May 2nd, 2026, to Becky Quick on CNBC. So we know what he was saying just a month ago. Let's talk about that as well. So all this and more. Again, I'm also going to be referencing the new blog that I have. So if you go to nataliepace.com and look for my blog there, you will see it. And of course, if you're watching this a couple of weeks from now, you may need to email info@nataliepace.com so that you can have a direct link. So, as I promised, we're going to dig into what Warren Buffett really said, especially in that most recent interview. And I quote, "Sometimes we do nothing. Prices look silly." That was from May 2nd. So Berkshire Hathaway has about 300, almost $400 billion in short-term treasury bills. That's a kind of cash and cash equivalent. 59% of the portfolio. That's as of the end of the first quarter, 2026. So we'll get news on what they did in a second quarter. We'll get more news on that when they do their next quarterly earnings report, right? So the second quarter doesn't end until the end of June, but they have a lot of cash on the sidelines. And I did watch a certain number of the tips that were offered, or actually someone had sent me over some of the tips that were offered in that deep fake Warren Buffett video. And most of them are directly in opposition of what he has been saying recently. So, just as an example, I did actually write a blog on this, and I do encourage you to check it out. So, it's called Warren Buffett's Investing Tips and that deep fake video. So, you want to know what he really did say, and that's what I go into greater detail here. Some of this is not what he said, but it's what we know to be true. So, inflation, do we need tips? Right? Do we need something that will inflation protect our portfolio? Well, what we've seen is that when inflation was at its high, its most recent high, and that was in 2021, 2022 era, that's when those tips investments had actually tanked. So you're going to see that chart. I believe I put it in this blog. So you don't want to, it has something to do with how the value of the bond itself, if interest rates rise, the value drops. So that was what is the real problem here, is that interest rates did rise really fast and the value dropped. So that begs the question, what about inflation? A, it is higher than they want it to be. And if inflation is sticky, then they will raise rates. The Federal Reserve Board, even under the new Fed chair, has made that clear. In fact, what I found, what I do, obviously, when I'm reading all my Fed minutes, is I'm also understanding what I call Fed speak. And what really surprised me about this Federal Open Market Committee press release, the most recent one from Wednesday, is that this Federal Reserve Board governor is even more transparent than Jerome Powell. So Jerome Powell always said, what was really going to happen, but he said it in a way that if you didn't quite understand euphemism or the way that the Federal Reserve speaks, it wasn't exactly clear. This most recent Federal Open Market Committee statement is very clear. The committee will deliver price stability. I mean, that is as clear as I have ever seen in because we had Janet Yellen before Powell, and she was very, very much alike with Powell in terms of how she did her communications. This particular committee is more clear. So what they're saying is, if inflation remains sticky, we're going to raise interest rates. That's the bottom line there. And no surprise, we are seeing that the futures market is saying, okay, well, we might expect not all of them, but 40% are expecting a rate hike at the next meeting, and that is going to be at the end of July, on July 29th. Now, what could change that? Well, the if the Iran deal holds, and it's going to take a little while, but we already have seen the prices for oil and hopefully gas will follow. We've already seen those go down just on the announcement of this deal. So I'm going to take a quick look at where they are today because yesterday they were under $80 a barrel. Yeah, 75, right? It had soared above 100. And so this is good news. It's not as low as it was. It was in the $65 range, but it's better than it was. And that could help ease prices. Now, it might take a little while for the gasoline prices to go down. And that's part of our inflation problem too, is that people are still paying more at the pump. But if they start seeing signs that they believe that this is going to hold and that prices are going to go down again, then we may not get that rate hike. And that's why there is, again, you're going to hear if you start really listening to these things, that the economy always has what's called a great degree of uncertainty, a high degree of uncertainty. And that is that there's just a lot of ifs in those sentences that I just said, right? If the Iran war deal, is over, if the Iran war is over, and if prices start to fall, we don't need a rate hike. If the war continues, or there's any reason why an oil shock is going to keep the oil prices high, that's an inflation problem, and we could have to have a rate hike. So I'll show you what's expected for interest rates, and it's not as bad as you might be thinking. So they're saying that actually they expect that there is no rate hike because right now we are at 3.5 to 3.75. Well, there could be a rate hike, is what they're saying, but we are at 3.5 to 3.75. So, yes, there could be one. And then next year, there could be a rate cut, one, right? So, it's not showing a great deal of movement in the Fed fund rate. So that's number one when we're thinking about those tips. But again, the tips are more complicated than just inflation protection. And as of now, it's looking like inflation may start to subside, but that is reliant upon this, the war being over and this deal holding and oil prices continuing to head in the south direction and gasoline prices eventually, hopefully, as well. So, tips, more complicated, not something I'd be that interested in. Inflation may not be here to stay. Also, if we start seeing job losses, that's when we have to worry more about disinflation, prices going down. So that's another thing that we're also watching. Now, right now, they're saying that the labor market is smaller than it normally is, but based on the amount of jobs available and the amount of people who want to work or are qualified to work, that's still fairly even. So we actually saw the unemployment rate expectations that they were expected to go higher in the last meeting. And now they're saying, hey, unemployment looked pretty good the last time. So those are all reasons to think that perhaps we're doing better than we expected and that things could stay fairly where they are. Now, one thing I want to say about the Warren Buffett videos and how you can tell easily if they're a deep fake. First of all, I put a link to his most recent interview. He doesn't do a lot of interviews. He most famously does them with Becky Quick at the Berkshire Hathaway meeting. So that May 2nd interview is something that he usually does once a year with her specifically for CNBC. Specifically, he hasn't done a commencement address, only one in 2020 for his alma mater. He has spoken at business schools, but most of those are over 20 years old. So if you're seeing someone and as to okay, well maybe he said it at a Berkshire Hathaway meeting. No, he was saying the opposite of a lot of the things that were being included in that deep fake. So first of all, if you're seeing a video of Warren Buffett that's not an interview on CNBC with Becky Quick, and by the way, he is slowing down a little bit. His age is showing up in his responses. He's still very sharp. It just takes a moment or two longer for the synapses to connect due to his age, right? So you can tell that he is an elder statesman in those interviews. In these deep fakes, he's kind of made to look like he's in his early 80s rather than his early 90s. And again, the strategies that they're putting in there are not things that he actually says. So what does he really say? First of all, he actually said bonds should come with a warning label. Secondly, when people think about buy and hold, like, oh, you should just buy this dividend stock and hold it. That's not what he does. He very famously exited General Electric stock right before they cut their dividend, and then they had to suspend it later on. Anytime there is a dividend cut or suspension, the price of the stock goes way down too, and it gaps down so you don't have time to change your position, your buy or sell position in it. So it's just really important to know what Berkshire Hathaway is really doing versus what those deep fake videos are saying. And again, if you want all of the details, then do read my blog. But one of the other things that I wanted to say, in terms of even he has said a lot of times, and this is true, that you'd be better off with an S&P fund than with a fund manager for a multitude of reasons that he believes. First of all, most managers, they're lucky if they do as well as the S&P 500. And even if they do, it's usually 2% under due to the fees. Now, the truth about it is that we if you just did the S&P, then, you were outperforming the Dow Jones Industrial Average Index. But if you were doing what we're doing, which is leaning into growth and HOTs, we even had more growth in our HOT funds, you're far outperforming just the S&P. And if you just did the S&P, you also had a lot of value in there, and the US value funds are not doing well, and they're not even paying as much income. So our value replacement funds that we're using, because the US is very heavily indebted, so oftentimes we're getting a higher credit rating, not often all the time, but like in one of our country replacement funds, it's a higher credit rating and it's a lot higher income. Peru was giving us a higher income, and the fund itself doubled in value. So what we're seeing is that by using our investing strategy on our HOTs and our value replacement funds, you're doing what Warren Buffett would be doing, which is lowering risk and leaning into things, but he rebalances. He doesn't hold a lot of Wells Fargo anymore. And again, he very famously exited General Electric right before that rate cut. So it's just important to realize that you should be very cautious because, and we'll talk about money market funds, T-bills, and annuities in just a moment. Because the person that sent us over the Warren Buffett video, when we said, hey, this is a deep fake, it even says it's a deep fake if you look at who published it. Then they were like, oh, well, he said this, so it's still good, right? And we're like, no, he actually said the opposite. So again, be cautious of these things. You might have even seen that very, very famous from, a few months back, a video of Tom Cruise fighting Brad Pitt, completely AI generated. What AI can generate these days is absolutely phenomenal. So, it is easy to get fooled, but yeah, and I know that. How do you know that Warren Buffett doesn't do commencement speeches? And by the way, I did link to all of the addresses he did so that you can see them, and he doesn't talk about anything in those videos. Um, how do you know that the strategies are completely opposite of what he does? Well, that's where I can be helpful. So you can always email info@nataliepace.com. Please, please, please don't email a link to a video and say, watch it and tell me what this means, because I do not have time to watch all the scams out there. What you can do is say, I watched this video and it says to invest in this, this, and this. What do you think? That I can do easily because you've asked me a direct question that I can answer rather than please watch this, which is going to take me 45 minutes to watch something that, I'm not that interested in those kind of I'm not interested in scams, but I'm not interested in other people's opinions of things. I'm interested in the true data that I am very capable of analyzing on my own. So ask the question and we'll get you the answer. I may have already answered it and Heather can just send you a link, or it may be something that everybody's, like, oh my goodness, they're going to jump into this. I better warn them right away. So I do a lot of investor alerts, and these are all coming from you guys. So thank you. So, bonds, T-bills, money market funds, and annuities. With regard to bonds, Warren Buffett very famously said that they should come with a warning label. We have seen problems in private credit. Money market funds typically get into trouble when the economy slows down. We have seen a little bit of trouble in them recently. Annuities are not FDIC insured. They often are very underperforming. We've seen 2%. It would take you 30 years to double your money at a 2% annualized return. It's really not worth it. Plus, the minute you buy them, you lose access to your money, like up to 9% of your money. They call it a surrender fee. And they say, oh, it's safe, you're not going to lose, but you do lose if you need access to your money or you want something that performs better than 2%. Also, other people have been chasing yield in private credit, and those were a huge problem we've been warning about for quite a while. So, what is Warren Buffett's favorite investing hedge, inflation hedge? His favorite inflation hedge is actually got nothing to do with investing in other people and everything to do with investing in yourself. He says that if you have a profession that you are really at the top of your game and it is in high demand, that's your best inflation hedge. And so that begs the thing that if you already are a parent or if you are a grandparent, that your best investment in the future is not necessarily an insurance policy or something that's going to give the kids a lot of money, although that could be great. Most people, though, when they inherit money or they win the lottery, they blow through it within just a few years. That's statistically true. But the best investment might be let's make sure that they are in a good school. K through 12 isn't great in the US, so you may need to really try to figure out what neighborhood has a great school or what private school that would be appropriate. And if somebody is graduated from college, sadly, right now, the best, the most available jobs are not for college graduates, they're blue collar jobs. That doesn't mean that they pay well, right? So if that college graduate that whether it's a child, grandchild, or a neighbor, if they are not, they're underemployed right now, and maybe they're driving for Uber, it is possible that the best thing for them is to think about graduate school, where unemployment is much lower. And of course, wages are even higher. You do have to invest in that. Isn't cheap to get a master's or an MBA. But I would strongly suggest that whatever is going on there, read the ABCs of Money or gift this to somebody. It does cover, parents should start reading it when their child is born, but it's never too late to do the right thing. So whether it's a grandchild, a child, that's, wherever they are on the scale, even you, let's say that you're stuck in a job and you're worried about job security, maybe due to AI. Is it time for you to get a master's, MBA, or PhD? Then there's a whole section on graduate school in there. So let's see what else I wanted to cover in this. I'm going to go back to the blog because I basically wanted to make sure. So here are the links to Warren Buffett's university addresses. They are a long time ago, most of them. And also, I did address the points point by point. So one person was saying, what about the dividend stocks? I talked about that. why that is a problem and why we're using value replacement funds, broad market index funds, why we like the pie chart strategy with 10 funds so that you can get hotter, increased performance and underweight risk by underweighting US value funds. There are reasons for that. We talk about it a lot at the retreat. Income producing real estate and why that's a challenge right now. As you can see, just the cliff notes on it, real estate and REITs. She thought, oh, this particular person thought, hey, I'll just invest in a REIT. But REITs actually lost money. And some REITs lost a lot of money. And some of those REITs were the ones that were paying the highest dividend. And then they cut their dividend and lost a lot of money. And now they're in real trouble. And of course, you have very little chance to make back all of the principal losses and you have no income. So, if I talked about tips above, low housing costs, absolutely. But buying high in a home, it can be really a problem. That could be a problem for a decade or longer. So, again, I do strong, and this will be in the description. A link to this blog will be in the description of this video conference and in the podcast. So you can watch it back, you can take it a little deeper, you can look at the charts more closely. And of course, anytime you have a question, feel free to email info@nataliepace.com. I also want to make sure that everybody knows our final retreat of 2026 is going to be October 10th through the 12th. We'll also have an earning income and bonds without pay for losses masterclass the following weekend. If you register for the retreat by June 30th, you get the best price and a free 50-minute private prosperity coaching session. So go to nataliepace.com and you can learn more. You can learn the 15 plus things that you're going to learn at the retreat. Just click on the flyer. And if you are interested in registering or you want any more information, just email info@nataliepace.com. We can register you by phone or send you a PayPal invoice. So thanks again. I'm going to stop it here for a moment because I do have a question that I want to answer that was emailed in to us. So one last thing before I answer the question. The market is at an all-time high. So if you have not rebalanced recently, now is a perfect time to do that. If you don't know what you own, even if you say, oh, it's all stocked away in a 401k, there still are things that you need to learn. And in addition to that, that you should have your own Roth IRA so you can start really building that up and put your HOTS there. Peter Thiel has $5 billion in his Roth IRA. So you can do this too. Let's follow the strategies of the 1% so we can get wealthier too. Now, this is the question that came in. She said she still has 5,000 in cash sitting in her Roth, and she wonders whether or not she should keep it in cash for now until the next rebalance, deploy it into existing allocations, or park it in a short-term CD until there's a clearer entry point. So what we talked about at the last retreat is that with stocks at an all-time high, of our 10 funds that we liked, 8 out of 10 were trading at an all-time high. So we said, why don't you dollar cost average and use a 2-year, 2-year plan? So that means, let's say if you had a $10,000 slice that had nothing in it, 5,000 over the first 12 months, 5,000 over the second 12 months. If you're doing that 3 times, let's say you're doing that twice, then 2,500 each time. But you would want to have a little bit of money available for the next purchase. And if it was twice in the year, it would be 6 months from now. If it was 3 times, then it would be 4 months from now. So that tells you what you need to do with that is that no, you shouldn't be just deploying it despite current levels or wondering about a clearer entry point because we don't know whether or not stocks are going to go up or down. What we do know is that stocks are at an all-time high, that 8 out of 10 of the slices we're looking at are at an all-time high. There are 2 that are pretty good prices that I would still dollar cost average, because if prices do go down, it takes down even things that are already low. Um, and I would just take a year to do that rather than the 2 year for the all-time high. So again, I would be data driven, right? Driven by data, not by whimsy. And I would want every dollar earning that 4%, which is about what we can earn right now, very close to that. And I would want to have money available for my next dollar cost averaging. So if I needed that $5,000 for in, 4 months, then it would be a 3 month CD. Or even you can do a 3 month bond, perhaps. Again, you want to make sure that you're adhering to all of the bond strategies because our bond strategies that we've been proposing and educating people on, there are no paper losses. We're keeping the term short, the creditworthiness high. We're leaning into the new and underweighting the old. We really basically are mostly interested in Magnificent Seven companies minus Tesla. Okay, so I am going to sign off and I'm going to give one last plug to my project, the Earth Gratitude Project. Remember, a lot of us can save thousands of dollars annually in our budget with more informed energy choices. And I do outline those choices both in The Power of 8 Billion, It's Up to Us, which is my book. Again, you can get that at nataliepace.com. And guys, whenever you're trying to get my book, please be sure that you're going to nataliepace.com so that you are assured of getting the most recent edition. So as an example, it's the 6th edition of the ABCs of Money, and you can access The Power of 8 Billion there. But I'm also encouraging you to go to theearthgratitude.org/2026 for our 21-day Earth Gratitude Challenge. We have Jane Goodall, we have Wildlife Direct, Ed Begley Jr., Common Ground, Queen Diambi, His Holiness the Dalai Lama, and much more on all kinds of things that are really going to help us in our daily life to be more sustainable with the added upside that perhaps we can even save thousands of dollars annually. So again, thank you for joining me. Email info@nataliepace.com if you're not already on our email list. Be sure to include videocon in the subject line if you want to make sure that you're notified before my next live video conference. And we do have people join us live. Thanks again.
One sunny day. Sunny day. Sunny day. At times I try to find some hope